Hello and welcome to the RedeConnect private credit panel discussion, the final installment in our series of 6 webinars over the last 3 days. I'm Alastair Baird, a principal at Rede, and I lead private credit fundraising. I'm delighted to welcome today 3 very well regarded and highly experienced LPs in the private credit space. They will be joining me in discussing some of the findings from Rede's recent credit survey, as well as providing their thoughts on the outlook for private credit in the current macro and geopolitical environment. So with that, I'll pass over to the panel so they can quickly introduce themselves, starting with Abhik from Golding Capital Partners.
Thank you, Alastair. My name's Abhik. I run Golding Capital Partners private credit fund investing and co-investing globally. Golding is a Munich, Germany-based alternative assets manager. We invest in private equity, infrastructure, and private credit. In the private credit space, we have about 4.6 billion invested in Europe and in the US across multiple strategies, with about 50 to 60% invested in more plain vanilla senior direct lending, about 25 to 30% depending on the vehicle in subordinated credit, and another sort of 25 to 30% again depending on the vehicle and the underlying client in opportunistic credit. And before joining Golding, I was on the direct investing side with a firm called Blue Bay, now Arcwood.
Thanks, Abhik. And Rick?
Good morning from New York. Thanks, Alastair. My name is Rick Jain. I'm a partner and head of global private credit at Pantheon. Pantheon's about an $80 billion alternative asset manager with interests in private equity, infrastructure and real assets, real estate, and private credit. Within private credit, we manage approximately $4.3 billion with primarily a focus on what we call credit secondaries, where we have the largest kind of dedicated focus on that particular part of alternative private credit. We provide a range of liquidity solutions across both GP and LP opportunities. We invest anywhere from 10 million to 250 million. In that part of our business, both in the US and in Europe across a range of strategies. We're also a very active co-investor and primary investor in private credit.
Thanks, Rick. And last but not least, Leo.
Yeah, thanks, Alastair. Hi, everyone. My name is Leo Fletcher Smith. I work for a company called Aksia. Aksia is an alternatives consultant. We cover all aspects of alternative investments. We work with clients which together represent just shy of 300 billion of assets under advisory. I'm a managing director in the private credit research team. The credit component of our platform represents about 80 billion of assets under advisory. About 10 billion of that is in discretionary capital. We aim to cover all sectors or all aspects of private credit, and we try to do that on a global basis, and we do it with at least what we think is a large and dedicated research team. And as I mentioned, I lead the European component of that private credit research business.
Thank you, Leo, and welcome all. So great. Just before we get into the discussion, I wanted to give some quick context on Rede's credit survey. Over the course of 4 months up to the end of January, we conducted 45-minute interviews with 50 leading credit LPs to discuss their private credit activity and appetites, as well as some specific topics which we'll touch on today, such as credit secondaries and ESG impacts. We spoke to LPs predominantly across North America and Europe, but also some prominent Asian LPs, and we covered all the major investor types. And when we look at their aggregated AUM, or assets under advisory, they accounted for more than $24 trillion, whilst their specific private credit allocation was closer to 340 billion. And when you look at the latest Preqin data, that represents about 25% of the total private credit allocation globally. So now on to the survey findings and some questions to our panelists. First topic is on whether the grey zone is getting color. We clearly saw from the survey that private credit demand is continuing to grow, which won't come as a surprise to many of you, with LPs increasing allocation to the asset class often faster than to other private markets asset classes. Our survey showed that whilst direct lending continues to be an important fixed income replacement allocation, LPs become more, as they become more sophisticated, they're increasingly looking up the return spectrum towards what used to be seen as a bit of a low double-digit IRR grey zone between senior secured fixed income replacement and equity-like strategies such as distressed mezzanine that could meet PE allocation return hurdles. So my first question to the panel is, how have you seen your and your clients' allocations and strategy focus shift over the last few years? And do you agree that there is an increased interest in what used to be the low double-digit return grey zone area? And maybe if we start with Abhik.
Yeah, sure. And I'm going to start by sort of going down, I guess, some of the history of Golding. So we started, the firm Golding started investing in private credit in 2003. And at that time, I would say the market clearly was predominantly a market focused on subordinated credit. So we have a legacy book or a legacy portfolio of mezz managers or managers focused on subordinated credit, some that we continue today. And so having said that, I think, you know, it's fair to say that we're probably not the most typical investor from a European standpoint. Golding represents about 300 European investors, and most of them, with all due respect to them, are probably less sophisticated, and that is why they invest through our fund-to-fund programs or our managed accounts or other dedicated vehicles. So, you know, having said that, I think what we see today, I'd say there are two types of clients. There are those that have been working and have been invested in private credit for many years now, say 5, 6, 7 years, and they are clearly looking towards that gray zone more and more, and not just within classic direct lending, but also in areas that are on this, looking at this chart, more PE-like, i.e. Looking at things that are on the opportunistic credit side of things, but also looking at strategies that have more of a PE-like characteristics with downside protection. So some of the strategies that are hybrid capital or structured sponsorless capital. And within the direct lending space, clearly there is a growing interest in some of those areas that are probably less, let's say, prominent, certainly from a European perspective. They're more prominent in the US, but again, from an overall market perspective, clearly make up a lower share of the overall market, which is things such as growth debt or venture debt, dedicated strategies focused on sponsorless situations on the senior side. This whole buzzword around specialty finance, whatever that means, but certainly we would categorize it as anything that is not necessarily purely focused on cash flow based lending, but also has areas in the areas of asset backed or asset based lending. So I think there clearly is a growing degree of interest, certainly what we see with our clients, but we continue to have many conversations with clients that are very new to the asset class. And for those types of institutions, clearly the focus is very much on the blue bar on the bottom right-hand chart, which is direct lending. I know you like to show 6 to 9%. I think a lot of our clients are actually happy with net 4 to 5% in some of their direct lending portfolios, especially those that are looking at direct lending as a pure fixed income replacement.
Thanks, Abhik, and that makes a lot of sense. And Leo, I guess your client base is pretty global. Maybe you could comment on how you see the evolution on that basis.
Yeah, absolutely. I mean, the slight challenge I have with these types of questions is exactly the point you highlight, Alastair. That our client base is very diverse, geographically, by institution type, by size. So it's very hard to condense all of those disparate objectives and behaviors into kind of a single cohesive view of how the typical Aksia client works, because, as I say, they're all just so very diverse. Some of the general themes I would say, now certainly direct lending will tend to comprise the cornerstone of most, not all, but most client portfolios. If you look at that another way, if you look at the workflow or the funds that we review at investment committee each year, and for context, we reviewed about 120 private credit funds last year at investment committee. About 30 to 40% of those are direct lending, so it's definitely the biggest component, individual component of the credit private credit spectrum that we or our clients look at. And you know, the reasons for that are quite straightforward. It's the biggest, it's the most accessible part of the market. When it's done well, it can be, you know, deliver consistent downside protected returns, etc., all of that kind of good stuff. But I would say, I mean, I think the more interesting thing is to look at the evolution of client focus over the past 2 to 3 years, and that's been hugely impacted by COVID. So where I think in a normal market condition, we might see generally about a third of client activity split across direct lending, distress and special sits, and then everything else, and the latter being real estate credit, real assets credit, especially finance, structured credit. Where that's the normal split, I think through COVID, things changed quite significantly, much more of a barbell skew. So if we look at your chart on the right-hand side of this page, either towards very defensive, downside protected, low risk strategies, or at the other end of the spectrum, going for quite opportunistic, distress-like strategies, looking to capitalize on that COVID dislocation. So I think there was definitely a disruption through COVID. I think we've kind of seen it normalize somewhat more to back to that third spread. But actually coming back to that point about the gray zone, and again, I think our client base is pretty diverse, but with that being said, I would actually say the bulk of the clients that we probably work with are exactly in that gray zone. Certainly some below, some above, but quite a lot in that gray zone. That's probably a feature of why they come to us, though, because you know they come to us for the to do the more challenging, difficult part of credit, which they can't necessarily do in-house. But yeah, as I say, I think the other element I would say there, it might reflect somewhat more mature clients, or ones which have had a longer footprint in credit. So I'm thinking particularly some, you know, US institutions which have been in and around credit for the past 10 years or so. But yeah, what I pause there and hand back.
And I think that kind of evolution and sophistication is important, and reliance on advisors and consultants for the trickier end is important. And like to that, I mean, credit secondaries is very much at the trickier end of things, Rick. And do you have anything you'd add from that perspective and what Pantheon's doing?
Yeah, I think this kind of focus on the gray zone kind of plays well to that, because I think a lot of LPs are trying to figure out, you know, they have their beta strategy around direct lending, and I think there's an increasing appetite to search for yield or return, and so it's kind of pushed people to look at these more opportunistic PE-like strategies, which are frankly pretty expensive and have a lot of cyclicality to them. And so I think when you can provide kind of a range of strategies, like credit strategies, which we'll talk, credit secondaries, which we'll talk a little bit about later, you know, I think it kind of scratches the itch around kind of that gray zone in terms of returns. We've set up our program where we can target both US and European exposures. So you can imagine the return targets for those types of opportunities vary differently, as well as opportunities that are more senior oriented, yield, sponsor-backed opportunities, which are a bit of a premium to typical direct lending, and then the more opportunistic strategies. So we've really tried to set up our program almost similarly to the way you've asked this question or gotten input from your clients, which is we think people want to consume their credit in different ways based on return, strategy, and geography. Great,
thank you, Rick. And I think that leads on to the other side of it, which is how allocations are set up and LP bucketing. And you know, when we look at how LPs bucket private credit, we saw some key changes since we conducted a similar analysis back in 2018. There was a significant drop in PE allocations being used for private credit, what used to be the home of distressed special sits and mezz, and quite a large increase. And this speaks to exactly what you were saying, Rick, around you know, what's generally termed something like broader credits, which has typically defined as private credit allocation with a broader return range remit, and often with some flexibility to invest in both illiquid and more liquid strategies. And this seemed to also go alongside more specialist professionals being responsible for private credit. How are you seeing LP buckets change to accommodate this shift? I mean, you are all credit specialists, but what do you see within your underlying clients in terms of increased role specialization? And maybe start with Leo on this one.
Yeah, no, I think it's a great question. I guess if I think back to when I joined Aksia 6 odd years ago, I think then certainly it was more common, more frequent to see credit investments to be thought of as part of, you know, a different asset class portfolio or part of a kind of a wider portfolio. That's definitely changed. I think almost all of our clients will tend to have clearly defined, clearly delineated credit programs. Again, not all. We work with a wide range, but I would say for the most part that comment is true. They will action credit investments generally out of distinct credit programs, and more often than not, they will have dedicated investment teams. And I think the point you mentioned, Alastair, is also very salient from a personnel perspective. And this is something which I've found really rewarding, is that we've seen a gradual but continual progression of the sophistication of client teams. And I personally think that's a great development. You know, we as a business are exactly set up to work with people who are highly literate in the types of investments they want to action. So it's fantastic. It means more, you know, better quality discourse, better understanding of credit investing. I think that's all been a super positive development, and it means, yeah, I would say in general the quality of conversations that we've had with clients has improved dramatically over that 6-year period. If you think about even something as, you know, reasonably straightforward as direct lending, where initial conversations were very much around what is it, proof of concept, that kind of stuff. More recent conversations are much more nuanced, much more specific: covenant mechanisms, EBITDA definitions, basket structures, the fundamental performance of underlying credits, and then importantly, how those factors drive our views about a portfolio or a manager. So yeah, I think there's definitely been this element, the kind of the LP sophistication has moved in the right direction, and I think that's been a really positive thing.
Great, thanks, Leo. And do you see something similar, Rick?
Yeah, look, I think we're seeing, I would agree with Leo. I think what we're seeing kind of more specifically is a continued shift from more liquid fixed income to private credit alternatives. And I don't see that kind of changing for a lot of our clients. We're seeing people look for more alpha generally in their strategies. And so, like I touched on before, I think people generally feel pretty comfortable with their direct lending exposures and managers. There's a lot of concern around those, around some of the things that Leo touched on, which I think are always concerns around how you think about that particular part of the private credit asset class. With respect to credit secondaries, we're finding people looking for more alpha. They're taking a little bit of what they might otherwise have done in direct lending and move it over to something that's more diversified, can get ramped up quicker. And then I think there's a lot of dissatisfaction around the more cyclical opportunistic strategies, and people are looking for other ways to try to get that, call it 13 to 16% kind of return. And that sometimes comes from private equity. That may bleed in from some more opportunistic allocation that people might have.
And just conscious of time we've got, but maybe Abhik quickly, if there's anything you'd add to this before we get onto the macro picture.
I think I'd agree with what Leo and Rick have said. I think one thing to perhaps add, most of our client base is German speaking or based in Germany, Austria, and Switzerland. And I'd say that this chart is very reflective of what we're seeing with that client base. which is that a lot of the newer institutions that are actually approaching us are very new to the asset class, and they are looking at private credit from that broader credit angle. And clearly you are seeing that shift, which Rick mentioned, from more liquid fixed income into something that generates more alpha. And actually, in many cases, when some of the LPs look at liquidity or weigh liquidity versus something that is more of an illiquid asset class, I think what we are seeing is more of a shift out of leveraged loans into private credit, as opposed to out of bonds, the investment grade side and the high yield side, towards private credit, as opposed to, I think the flows are actually happening out of leveraged loans into private credit and not out of other more liquid forms of fixed income.
That's a very interesting dynamic. And just moving on now to the macro picture, and just on this slide, it's a mixture of some of our survey findings and also just some market data at the moment. I mean, the macro picture today is looking increasingly concerning. When we asked LPs about their expectations of a cycle correction during the survey, which concluded in January, the results were fairly mixed. When we asked the same as a poll at Super Return Credit in London in March, after the outbreak of the Ukraine-Russia war, there was a much more pronounced expectation of a correction. And we're now seeing an environment where there's public equity market volatility, there's commodity cost rises, increasing inflation figures, an expectation of ongoing rate rises, particularly from the Fed. So I'd like to ask you, private credit strategies appeared to fare pretty well through COVID, and Leo touched on this already slightly, but how should we think about things in the current and likely ongoing macro and geopolitical environment? And maybe Leo, you could pick up on that as a starting point.
Yeah, sure thing. Look, I mean, we get an absolute ton of data from the GPs that we work with, which allow us to look at a whole bunch of stuff. I'm not going to bore everyone with the nuances of it now, but what is really interesting about it is that we can use that data to understand how borrowers are performing at a kind of revenue, EBITDA, leverage level. So I guess why I mention that here is that gives us a really interesting context prior to the Ukraine war to understand how Europe and the US were doing. And as I say, I won't go into the nuance, but in a nutshell, the US recovered a bit quicker, borrower stress abated faster, and to a more significant degree than we saw in Europe. So there were already some headwinds, or at least an element of lag on the recovery that we saw within Europe at in terms of underlying borrowers, in terms of mid-market corporates. So that, I guess, to us is quite a relevant backdrop. And then what we have is what we've all seen, war in Europe, which is, to be candid, something I never thought I would see in my lifetime. Maybe that's a naive view, but something I never thought I would see. But I think it's probably not very controversial to say that the impact of that will be more pronounced. The impact of that conflict will be disproportionately more pronounced in Europe than anywhere else. So you combine the pre-existing view of how we saw the corporate recovery in Europe versus the US with the disproportionately significant impact of the Ukraine conflict on Europe. And yeah, it kind of adds up to a picture which suggests there are more headwinds for growth in Europe than we've seen for a number of years. I guess what I would, one thing I might pick up on is the way you characterize that as concerning, Alastair. And it is concerning, but predominantly for performing corporate or performing credit strategies even. Those are the ones where return distribution is asymmetrical. It's the downside which will drive deviation in track records. Those are the ones where you will probably see lower quality GPs may start to demonstrate underperformance going forward if lower quality underwriting starts to be shown for what it is as a result of these macroeconomic headwinds. I guess conversely, if you're looking at more opportunistic or distress strategies, you could give exactly the opposite commentary to your
Yeah, no, I think that's a very salient point, and the use of the word concerning was probably more on kind of looking at personal finances rather than investment.
And electricity bills as well, right?
And electricity bills, exactly, or electricity providers. But I mean, maybe Abhik, just more generally across that leads on to a point on more generally the private credit asset class and how you see that performing in a trickier environment.
Yeah, look, I mean, perhaps starting with the inflation protection point, which is this slide. I mean, 90 to 95%, I think even closer to 100% of the private credit asset class is floating rate, and so naturally or inherently there is some degree of inflation protection in the sense that obviously if rates rise, your returns should be protected. That's obviously very different to the liquid market or the bond market, stating the obvious. But I think generally speaking, to your general question, I'd also say that the vast majority of the businesses that are financed through private credit funds still are middle market businesses. They tend to be businesses that don't access the larger, more liquid leveraged loan markets or high yield bond markets. That's changed somewhat, and we've seen many large deals happen over the last sort of 12 to 24 months. But generally speaking, a lot of these companies are middle market businesses, and so clearly they are inherently more susceptible to certain cost pressures, and I think you're seeing that in a number of portfolios. You saw that already going into sort of Q4 of last year, and I think it continues to date that a lot of these businesses are seeing some level of pressure, and that's where obviously the underwriting quality comes in, which Leo mentioned. But again, going to the sort of general instruments or toolkits that most private credit funds have, and that's both on the direct lending side as well as on the subordinated side. I mean, obviously with different nuances, but generally speaking, most of these lenders typically are the sole lender, or they are in a concentrated pool of lenders. So that means that they should be closer to the companies and the management teams that they're invested with, which also means that they should be able to react in a proactive manner when things don't go so well. And in the context of that instrument or toolkit, one very important thing, which Leo touched on, is documentation. And that's not just covenants, but that is strong information rights, the ability to call up the management team or have a meeting with the management team at a very early stage, well before there is any covenant breach. I think it also has a lot to do with the fact that, going back to that sole lender point, if you compare that to the leveraged loan market, where you often have 30, 40, 50 parties in a capital structure, typically in a private credit capital structure, there are 3, 4, 5 parties. So it's clearly easier to find a solution to a problem. And then I think, going back to some of the sort of the nature of how some of these private credit funds are set up. And again, there's obviously a huge dispersion between the different managers, but generally speaking, I think most of the managers that we're invested with are not shy of taking the keys. Now, that is clearly the last resort, but a lot of the managers, good managers that have that good underwriting quality, should also be in a position to ultimately drive favorable outcomes for their LPs if things don't go so well. So I think generally from an instrument and toolkit perspective, there are a lot of downside protection elements in there that should protect an LP going into a wider downturn.
And I guess that given there's been such a shortage of workouts, that probably sets the stalls apart slightly in terms of quality of those that have workouts. But just going back to something that Leo was touching on around kind of the distressed opportunity or special sits opportunity. And I guess in 2020, 2021, we heard a growing narrative that traditional distressed opportunities or the opportunity was over and investors needed to evolve to be more flexible and take a kind of opportunistic credit approach. I think Oaktree were pretty vocal in that, and that's a strategy that can tackle both non-performing and performing credit in a higher returning context. But was the end of traditional distressed investing called too early, given the environment that maybe Europe is now heading into?
Happy to start. I guess, look, I mean, one thing, and again, going back down the memory lane, if you look to 2013, 2014, there were a lot of very large distressed funds that I think piled into a very large capital structures, but actually the opportunity set was quite limited. And these are all very smart investors, no doubt, but the number of distressed funds that had the same position in their portfolio sheets, or the same name in their portfolio sheets, I think was very telling of the market. I think the opportunity set for some of these larger capital structures that were distressed or that were broken was quite limited, both in North America, but also in Europe. And so I think certainly what we've seen with our clients and where we've geared them towards is to focus on opportunistic credit managers that are more flexible, that can work in both more liquid situations, more public situations, but also can work in private situations, can originate private situations, almost like a traditional direct lending fund or some of the other funds that we talked about, because I think it's important to have that flexibility and to be nimble. And if you raise too much capital, I think that becomes quite difficult. And so I think, looking back the past few years, I think that opportunity set for very large capital structures that were challenged or broken, and where there was a trigger, the possibility to actually do something, were quite limited. Now, going, looking to 2023, 2024, I mean, I don't have a crystal ball. I don't think any of us have that, but clearly there've been a lot of larger capital structures, companies that have larger companies, especially in the leveraged loan market, that have raised money on the basis of questionable EBITDAs and have relatively elevated leverage levels. And so if you have a widespread downturn going into, say, 2023, 2024, I think some of those larger broken capital structures could reemerge. But I think we still favor more nimble funds, funds with more, let's say, concentrated fund sizes, and not the 16 billion animal necessarily, so that one can try and remain relatively disciplined and have a relatively high level of diversification still in those funds, rather than piling into certain larger capital structures, which often also come in certain specific industries, which then creates an over allocation to certain industries as well.
Yeah, if I might add, I would say, this time around, which is, not too distant from the last time around, which was only during the kind of COVID dislocation, you really have to ask yourself, how much do we really think that government liquidity is going to be extracted out of the system, right? So you have interest rates going up, there's going to be liquidity that's going to be taken out of the system. It might be different in Europe, but certainly the Fed here has signaled that they're going to take liquidity out of the system, and they haven't done it yet. So if you really think that's going to happen, there's not going to be this kind of government support for credit or for the system, I should say, then I think reasonably one could expect the distressed opportunity to be probably a little bit more compelling and interesting. But as Abhi touched on, there's a lot of competition there. There are a lot of funds of immense size that need to be deployed. I'd maybe add a couple of things just on the implications for a cycle. One is, I think there's going to be more lender on lender battles in crime. So there's going to be a lot of battles with sponsors, battles between lenders around the documentation and credit agreements that have been done over the last number of years. So expect to see more battles that way. I think you're going to expect to see kind of more default activity and loss activity, particularly on the direct lending and performing lending side. And then I'll put this to everybody. I think you'll see more people move from originations into workout groups. And I think, for people who've been more astute in seeing this, we're certainly seeing more private credit groups put postings out and asking people to move into workout groups, starting to staff people to take care of more lender amendments and refinancing activity and the like. So I think those are some things to kind of think about in terms of what could happen with the next cycle correction on different credit strategies.
Thanks, Rick. That's some good predictions, which we'll see whether they come true or not. The last thing I wanted to touch on this slide is a topic that was mentioned already around specialty finance, and it was particularly well cited by many investors we spoke to in the survey as being of increased interest. There's clearly a range of strategies within that definition, but how do you define specialty finance? What is the opportunity, and is it more or less attractive in this environment? And I don't know, Rick, if you wanted to continue on that.
Sure. I'll briefly touch on specialty finance. So we've spent a lot of time in this space. We've invested in it, and I think I've invested in it on a direct basis myself at prior firms. So specialty finance, I think, is this wide-ranging kind of area of alternative credit where people are trying to get current cash flows in a non-correlated way versus corporate credit exposures. So the way in which you can get access to those shorter duration cash flows is by betting on a number of different sectors, whether it's kind of consumers, whether it's commercial exposures, anything from small businesses all the way up to kind of larger companies, and then real estate. And often a number of these different verticals within specialty finance are benefiting from really positive trends related to e-commerce, the digitization of payments, as an example, and just the use of data in an immense way to better evaluate credit quality, underwriting, loss performance, and where ultimately returns are trying to be. And I think investors are trying to, have been inundated with so much direct lending and opportunistic credit that they always try to find kind of different ways to kind of play the market. And certainly specialty finance probably has a spot in the market for different people. We do think it's interesting, but it's a very tough space to kind of diligence and look through. I think for people who don't have a background in private credit or have invested in these types of sectors, one of the biggest things that we always talk about is how do you invest in, let's say, consumer specialty finance in an environment like COVID, where there's so much government support and so much stimulus? How do you adjust your credit models to really predict and understand where credit performance is really going to go? And the same goes for businesses. The same goes for housing and real estate. Right now, you have interest rates going up. You have a constrained housing stock. You have kind of huge demand for housing. So obviously, you have to try to find the right types of managers that can solve for all of these different variables and challenges. But certainly, it's an area that we do think is interesting. It's not without complexity.
Thanks, Rick. And just as the time ticks by, I don't know, Leo, if you'd agree with that, and whether you see your clients have interest in this space.
Yeah, no, I would certainly agree with the complexity point. From our client perspective, I mean, I kind of outlined the big picture split between different where clients are active. I think if we look at specialty finance specifically, it's generally about 10 to 15% of what we do for our clients each year, and that's by number of funds, not by value of investments, but by number of funds we review. It's about 10 to 15%. And why do they do it? Well, yeah, I mean, the fundamentals can be really interesting. You can see a very broad range of fundamentally different investment strategies that can allow LPs to significantly diversify risk exposures, potentially generate a return premium versus other areas of the private credit universe. And on the whole, I think whilst I would say that we saw client activity levels really drop off through COVID, as there was, I guess, a bit of a flight to the kind of bigger blue chip managers. Generally, most of the, and notwithstanding my comment about specialty finance comprising a whole range of unrelated stuff, generally the underlying strategies tended to do okay through COVID, which has helped to increase LP confidence that some of the more esoteric strategies out there can successfully navigate these macro shocks. So I think in general though, they tend to comprise, satellite type exposures for most LPs. That point around complexity being a barrier to access for some LPs, I think that is very right. That's very salient. I think it's quite easy for LPs to get over their skis when looking at specialty finance, because it is inherently comprised of a range of very unrelated strategies. It's often each one of which might require very specific skills and technical competence to understand. So therefore it can be quite tough for LPs to really form kind of clear, nuanced views on each of the different subcomponents. So yeah, and look, for us, what does specialty finance include? It's an awful lot of stuff. It's consumer and SME lending, rediscount lending, factoring receivables, RegCap, royalties across film, music, media, across energy, healthcare, venture lending, insurance, litigation finance, etc., PE portfolio finance. All of that stuff is entirely unrelated to what I listed before and after it. So it's, as I say, it's a tough one for LPs to access sometimes, but it can introduce really interesting dynamics to portfolios.
Thanks, Leo. That's a really good run through of many of the specialty finance strategies that sit underneath the hood. So just in the last 5 minutes or so, I did want to have a bit of time to discuss some of the other trends that we found. And the first one is on credit secondaries. We asked LPs about their appetite for credit secondaries, and whilst the majority currently weren't investing, there was a clear intention to do more in the future, and there's a desire to understand the opportunity better. And Rick, I guess you're an early mover in this market and have seen the credit secondaries market evolve. So it'd be great to just get your thoughts on what the most attractive opportunities you're seeing in the market today are, and that evolution.
Sure. And I know we have limited time, so I'll hit some of the high points. So I think in terms of the evolution of credit secondaries is really kind of followed the growth of the primary market, right? So there's been, you now have probably almost 1,500 private credit firms operating globally, managing anywhere from $1 trillion to $1.5 trillion, which might even be understated in terms of the total, addressable kind of universe of opportunity, because opportunities exist in non-traditional kind of closed-end vehicles. If you include BDCs or other parts of the market, it's a fairly large market. We've seen our deal flow just as a good barometer of both kind of LP acquisition opportunities, as well as opportunities that we call kind of more GP-led, which can include things like continuation funds, strip asset sales, addressing tail end exposures for people. These are a whole range of liquidity solutions. We've seen our market grow from about $5 billion of deal flow in 2018 to over $18 billion of deal flow last year. And we saw just in the first couple of months of this year, I wouldn't necessarily annualize it, but we saw around $5 to $6 billion of deal flow in our market. So the market is here, it's large, it's growing, it's inefficient, it's capital constrained, and it's fairly alpha rich because there's very high barriers to entry into a business like this, because you need a dedicated team that's focused on credit, you need data, you need information, you need relationships, you need scale capital to compete. We can write checks up to $250 million at a time. And I think more and more people, as they look for different niches in credit, will see that both the absolute returns and risk-adjusted returns in this part of the market will be really attractive. We typically tell people, don't throw away all of your primary exposures to the managers you like and the strategies that you like. But if you're looking for opportunities that are highly diversified, which credit secondaries can provide, because you're diversified by not only company, but by industry, vintage year, and strategy. This is a very interesting place to play. There's very little J-curve. There are short duration opportunities. They are kind of risk on, risk off. So we think the market is going to increasingly grow towards this part of the area. You've seen more competitors come into the market. to try to establish platforms. And so we think the future is really bright in this area, and it's certainly an area we see more and more people focusing on.
Thanks, Rick. And I guess, Abhik, rather than having a dedicated credit secondaries fund, you sort of maybe look to pick around at some specific opportunities to be additive to your portfolio. How do you think about the credit secondaries market in that context?
Well, now that Rick has one, we're going to do one. We're going to launch one as well. No, I'm just kidding. But I think obviously Rick hit on a lot of the points. I think if you look at the growth of the private equity secondary market, then naturally, following the growth of the primary market on the private credit side, you'll see more secondaries activity. And I think we're seeing a lot more secondaries activity on the private credit side than perhaps we did 3-4 years ago. If I look back to when I joined Golding, most of the secondaries that we had done on the private credit side were purely with opportunistic credit managers that had higher returns, where you could see some element of upside still with the transactions. I think the challenge with looking at the larger part of the market that is lower returning is to really see that upside, especially if you have a very large private credit portfolio and you know the underlying portfolios or the portfolio companies well. Sometimes I think that is the challenge, but clearly Rick pointed to some of the GP-led activity, some of the continuation funds that clearly can provide a suitable liquidity option for many LPs, but can also create a lot of interesting opportunities for both the GP and the LP and the underlying investor in some of these credit secondaries. So I think it's just another element of the growth of the market that everyone should continue to follow very closely.
Thanks, Abhik. And then just given time, I wanted to move on to the final topic and maybe try and cover this off in a quick 5 minutes. But ESG impacts. When we asked LPs about ESG and impacts, it really came out in two main areas. The first was on the importance of ESG and DD in decision making on credit managers, and the response lined up pretty well with expectations we see on the PE side, where managers generally were faster to adopt ESG initiatives, given greater control over investments. There was a clear message that any credit managers who are not yet taking this seriously need to raise their game ASAP to remain credible. We also asked more specifically about LP appetite for specific impact sustainable credit strategies. And this is what I'd like to ask you about. As the survey showed, a relatively low appetite, often driven by a sentiment that lenders had less control or influence. But with the picture ever changing, I know, for example, Leo, you have some specific impact credit client sub-mandates. So I'd be interested just to get your thoughts on that area of the market.
Yeah, no, that's right. I mean, it's we probably have a handful of client-specific mandates to pursue primarily and predominantly ESG goals. So that's something which has arisen probably over the last 18 months. Equally as valid, I would say, is the general degree of focus, attention, and discourse with our clients on ESG. So even where we might have a more kind of plain vanilla direct lending mandate, the focus of ESG within that is at a level which, to be candid, is quite surprising to me in a very good way. It's not something I expected to develop and cement this rapidly. There is, I think, an element of challenge here, or an element of dislocation between, on the LP side, those dynamics I've just touched about, LPs often wanting to prioritize it, wanting their managers to prioritize it. And then on the other hand, particularly when you're looking at performing credit, it's the ability of managers to actually implement something with meaning. Negative selection, i.e. not backing borrowers with poor ESG credentials is certainly one avenue, but driving positive behavior, I think, is a real challenge. That being said, we do see various developments which I think are positive, but which aren't an end in and of themselves. Things like ESG margin ratchets would be one, but the materiality, the impact that has on borrowers is often quite limited. So I think I think things have, I guess I would say, things have moved a lot faster and further than I would have otherwise expected from the LP community, and that is to their credit. What we now need is to join that with, on the credit side, GPs being able to actually drive some positive behavior. And that's something which I don't think there's an easy answer to. It's not a straightforward thing, and I think we'll go through a number of probably different phases of GPs trying to understand different ways that they can do that. But yeah, general trend has been, I think, unanimously positive, probably more so in Europe than the US from a GP perspective. General trend has been very positive, but there's that slight dislocation between what LPs want and what credit GPs are actually able to do, which I think will go through a few waves of evolution over the coming quarters and years.
I guess that European evolution being a bit quicker maybe has something to do with the SFDR regulations. And Abhik, I don't know whether you have any thoughts on the implementation of that and what you're seeing from managers.
Yeah, look, I think it's one area of the market where clearly Europe is ahead of North America, and SFDR clearly plays a role. I think we see a lot of Article 8 funds where clearly ESG is at the forefront, and a lot of the managers are looking to create some positive behavior. Whereas I think we're not seeing many Article 9 funds. Looking at the right-hand side of your page, we've seen some of these Article 9 funds where impact is really at the forefront, but a lot of them are actually lower returning. And so in that context, I think if you weigh again, looking back to some of the points that, or thinking back to some of the points that we discussed in terms of liquidity versus illiquidity, I think you still need to generate illiquidity premium with private credit funds. And so I think that is where a lot of LPs are still struggling. How much positive behavior can you actually create? And that goes to Leo's point. But I think generally speaking, if we look at some of the Article 8 funds and some of the positive change that has happened over the last few years, looking at the senior side, and obviously if you look at the PE-like, more the PE-like strategies within private credit, I think there are actual things that are happening from both from a negative and a positive control perspective, i.e. Lenders, often if they even have a share of the equity, they can actually create some change in the underlying companies, both from an E perspective, an S perspective, as well as obviously from a G perspective. But looking at the senior side of the market and that negative control element, I think that is where clearly there are certain limitations as to what a lender can do. But yes, look, one can argue about the benefit of these ESG linked margin ratchets, but I think you're seeing more and more that both borrowers and their underlying owners or sponsors, as well as the lenders, are seeing some benefit to it. Now, we can debate whether a 5 basis point or a 10 basis point benefit, if you achieve certain ESG goals, is very material. But I think it's a good start, and I think it's a good start that one can build on. And so, especially if you think about some of the funds that are being raised currently with a dedicated Article 8 SFDR framework around them, I think that is a positive stepping stone in the right direction for some of these some of the things that obviously LPs are looking for from an ESG perspective.
Thank you, Abhik. And I think with that, sadly, we've probably run over time. But we've covered a lot, and a big thank you to you, Abhik, Rick, and Leo for joining today and sharing your valuable insights and for the informative discussion. This is our last webinar and concludes the RedeConnect conference. So I'd also like to thank everyone on the line now and all those who took part over the last 3 days. I'm pleased to say that we've had over 650 participants join us across the 6 webinars and 120 GP LP roundtables. So we hope you found the conference helpful and informative, and hope to see you all back next year. But thanks once again to our panelists today and for your time. Thanks very much.